If I gave 10 different people $1 million to invest today, what do you think would happen? Some would put everything into a single stock, some would buy real estate, some would leave the money in cash, some would spread it across hundreds of investments. And 10 years later, their results would likely be dramatically different. Why? Because successful investing isn't just about how much you invest. It's about how you invest. And one of the biggest mistakes new investors make is focusing entirely on returns while ignoring portfolio structure. They spend hours looking for the next big winner, the next hot stock, the next market opportunity. Meanwhile, experienced investors are asking a different question. How much risk am I taking? Because building wealth isn't just about making money, it's about keeping money. And in this episode, we're going to explore one of the most important topics in investing: asset allocation. You'll learn the difference between stocks and bonds, how diversification protects your portfolio, how risk changes throughout your life, and how to build an investment strategy that actually matches your goals. When most people start investing, they focus on what to buy: stocks, ETFs, funds, real estate, cryptocurrency. But before choosing investments, there's a more important decision to make. How should your portfolio be structured? Because research has repeatedly shown that asset allocation often has a larger impact on long-term outcomes than individual investment selection. In simple terms, how you divide your money matters a lot. The purpose of a portfolio isn't simply maximizing returns. It's balancing growth and risk, and finding the balance that's right for you. Let's start with stocks. When you buy a stock, you're purchasing ownership in a company. You're becoming a shareholder. If the company grows, earns profits, and increases in value, your investment may grow as well. Historically, stocks have been one of the most powerful wealth-building tools available to ordinary investors. Why? Because businesses create value. They innovate, expand, generate profits, and over long periods of time, many companies become worth significantly more than they were in the past. That's why stocks are generally considered growth assets. They offer the potential for higher returns. But those higher returns come with higher risk, because stock prices don't move in straight lines. Markets rise, markets fall, sometimes dramatically, and investors need to be prepared for that reality. Now let's look at bonds. A bond is essentially a loan. When you buy a bond, you're lending money to a government, corporation, or other organization. In return, they agree to pay you interest and eventually return your principal. Compared to stocks, bonds are generally considered lower-risk investments. They typically produce lower returns, but they often provide greater stability. This is why bonds are frequently used to reduce overall portfolio volatility. Think of stocks as the engine, and bonds as the shock absorbers. One helps drive growth, the other helps smooth the ride. Here's a question many investors never ask themselves. How much risk can I actually tolerate? Notice, I didn't ask how much risk you think you can tolerate. I asked how much risk you can actually tolerate, because these are often very different things. Everyone feels comfortable taking risk when markets are rising. The real test happens when markets fall. Imagine your portfolio drops 20%, 30%, 40%. Would you stay invested, or would you panic and sell? Your answer matters, because the best investment strategy isn't the one with the highest theoretical return. It's the one you can stick with during difficult times. And that requires understanding your true risk tolerance. The cost of panic. One of the biggest threats to investors isn't market crashes. It's emotional decision-making. History has shown that markets recover from downturns, but investors often don't, because fear causes them to sell at the worst possible moment. Then uncertainty keeps them from reinvesting, and they miss the recovery. This cycle repeats again and again. People buy when excitement is high, then sell when fear is high, which is exactly the opposite of what successful investing requires. A properly structured portfolio helps reduce this problem, because when your risk level matches your comfort level, you're more likely to remain invested through market volatility. And remaining invested is often one of the most important ingredients for long-term success. Your financial safety net. Now let's talk about diversification. One of the most powerful concepts in investing. Diversification simply means spreading your investments across multiple assets rather than relying on a single investment. Why does this matter? Because nobody knows the future. No investor, no analyst, no financial expert. And concentrating all your money into one company, one sector, or one investment dramatically increases risk. Imagine putting your entire life savings into a single stock. If that company performs well, you may do very well. But if something goes wrong, the consequences can be devastating. Diversification helps reduce that risk. You're not betting everything on one outcome. You're building a portfolio designed to succeed under many different conditions. Don't put all your eggs in one basket. You've probably heard this phrase before. And while it's simple, it's incredibly powerful because concentration can create wealth. But diversification often helps preserve it. Many investors become overly confident after a few successful investments. They believe they've found the secret, the winning stock, the winning strategy. Then reality reminds them that markets are unpredictable. Diversification isn't exciting, it's not glamorous, but it works, and over long periods, boring is often very profitable. One of the biggest factors influencing portfolio design is age. Why? Because age affects your investment timeline. A 25-year-old investor may have 40 years before retirement. A 60-year-old investor may have far less. That difference changes everything. When you're younger, you generally have more time to recover from market downturns. You can afford greater volatility because time is on your side. As retirement approaches, preserving capital often becomes increasingly important. This doesn't mean older investors should avoid growth entirely, nor does it mean younger investors should ignore risk. It simply means your investment strategy should evolve as your circumstances evolve. Your portfolio should match your life. Here's a mistake many investors make. They copy someone else's strategy. A friend, a social media influencer, a coworker, a financial celebrity. But your portfolio should reflect your situation, your goals, your timeline, your income, your responsibilities, your risk tolerance. The perfect portfolio for someone else may be completely wrong for you. That's why personal finance is personal. Because investing isn't about finding the universally best strategy. It's about finding the strategy that's best for your life. One of the most surprising truths in investing is that successful portfolios are often remarkably simple. Many investors spend years searching for complicated strategies, advanced techniques, market predictions, secret opportunities. Meanwhile, some of the most successful investors simply follow a diversified plan consistently for decades. Why? Because consistency often matters more than complexity. The ability to keep investing, keep contributing, keep staying invested. That's what creates results. Not constantly changing strategies, not chasing trends, not trying to outsmart the market every month. Let's talk about one final risk: concentration risk. This occurs when too much of your portfolio depends on a single outcome. A single company, a single industry, a single country, a single investment idea. The problem is obvious. If that one area struggles, your entire portfolio suffers. Diversification helps protect against this, because even when one area underperforms, others may continue performing well. You won't always have the highest returns, but you're also less likely to experience catastrophic losses. And avoiding catastrophic losses is one of the most important rules in investing. The goal isn't perfection. Many investors become obsessed with finding the perfect allocation, the perfect ratio, the perfect investment mix. But perfection doesn't exist. Markets change, economies change, your life changes. The goal isn't perfection. The goal is building a portfolio that supports your objectives while allowing you to sleep at night. A portfolio you can stick with. A portfolio that aligns with your goals. A portfolio designed for the long term. That's what matters most. Successful investing isn't about predicting the future. It's about preparing for it. Own growth assets like stocks. Use stabilizing assets like bonds when appropriate. Diversify broadly. Understand your risk tolerance. Avoid concentration risk. And remember that your portfolio should reflect your goals, not someone else's. Because investing isn't a sprint, it's a lifelong journey. And the investors who succeed aren't necessarily the smartest. They're often the most consistent. In the next episode, we're going to shift gears and examine one of the biggest wealth destroyers in modern life: cars. You'll learn why so many people sabotage their financial future with vehicle purchases, how financing really works, and the simple rules that can help you enjoy a car without sacrificing your long-term wealth. I'll see you in the next episode.